So a couple of months ago, Vanguard published a blog saying that the next decade for investors is not going to be quite as kind as the one that we're in right now. As you might already know, the current market conditions we're experiencing have been the longest bull run we've ever seen since the end of the financial crisis around 2009. The markets have pretty much been in a straight direction all the way up. Almost every stock you could have picked has gone up, especially tech stocks. They've gone absolutely crazy, and everyone now thinks they're some kind of stock guru, when in reality a monkey could have done it, but things are going pretty crazy. In summary, in their blog post, Vanguard say that investors need to be a lot more cautious, certainly over the next decade, than they have been, and expect a lot lower returns than we've been used to. So in reality, what this means is rather than expecting those returns of maybe 8 or 10%, which we always band around, we need to be reducing our expectations significantly over the coming years. And those numbers which we need to expect, you're not going to like this, are around 2.4% to 5.2% on the generous side of a compounded annual growth. To put that into perspective, just a few percentage points might have, especially for a long-term investor, it's pretty crazy. Let's just run through a quick example to show you how much that could affect your investments over the long run. Let's just say you put $10,000 or £10,000 into a single investment pot and you get 10% every single year for the next 20 years. You'd end up with a figure that's $73,280. Pretty impressive. But if we drop our returns down to 5% every single year, the amount we're left with is significantly even lower than half. That amount is £27,126. Now, I don't know about you, but as an investor over 20 years, those returns would be pretty poor, and I think you'd be pretty frustrated if that was the number that you ended up with. But let's get real. Is everything they're saying here all just bad news? Well, let's just look into some of the few details to really understand what they're telling us in this data they're providing for us in this blog post. In summary, they're saying that their initial forecasts were actually pretty much spot on about where they expected us to be just from a few years ago, and that's all based around a 60-40 portfolio, which means 60% in equities and stocks and 40% in bonds. And this 60-40 holding was what John Bogle, the founder of Vanguard, actually held himself and how he split his investments. However, while they may have hit that overall forecast bang on the head, they did get a couple of things wrong and a couple of little details, so let's just check into those now. Firstly, one thing they did is underestimate the power of the US stock market, and as you can see on this graph, the US stock market rallied a lot harder than they ever expected. And on the flip side though, they overestimated what the non-US stocks could have done, and actually the non-US stocks have underperformed some of their expectations. So great news of course for anyone holding US stocks, certainly people like myself or anyone just holding the S&P 500, that's been on an absolute tear and an absolute rally recently. But everyone not holding those stocks, maybe people who are heavy in bonds or holding those international markets, have not seen such great returns. Vanguard conclude the research by saying that the big gains of recent years make similar gains tomorrow that much harder to come by unless fundamentals also change. And that does make total sense. Just remember how difficult it is to move the needle of a share price, let's say trying to get it from $1 trillion to $1.1 trillion, getting that 10% gain is a lot more challenging to move the needle than going from say $100 million to $110 million. But hang on, it's not all bad news. I'm not a doom and gloom merchant, so let's just pick out a couple of potential positives from this article and actually let's spin it in our favour to work out if we should actually change anything in our investment strategy. Firstly, it's perfectly okay to plan and expect for the worst over the next 10 years in your investment, but be hopeful that you actually get more than you bargained for. In fact, I think this is a much better place than being too optimistic and setting your sights too high, because really you're only going to set yourself up for failure and set yourself up to be pretty disappointed in the future. If you change your investing habits and investing behavior based on some lower expectations, but you can still meet your goals, then that is exactly where you want to be. That's a really nice place to be. Or if we do get some good news and you find out that you're outperforming the market and you're outperforming those low expectations, then great. You can either retire early, change your goals, take some money out for a lump sum or whatever, but ultimately you'll be pretty happy and pretty impressed. But if things go the other way and you expect too much and you actually get back a lot less, that's not going to be a pretty place to be. I'd certainly rather do this than expect I'm going to get 10% in the market every year for the next 20 years, lower my expectations, plan for those expectations, and then if things change, I can adjust depending on that. Secondly, what this tells me is making any kind of predictions, especially in the investment and finance world, is an absolute nightmare because it's impossible. Who could have foreseen 2020 at all? If you were making 5 or 10 year predictions back in 2016, trying to predict for what might happen to the market and the subsequent bounce back afterwards, all the money printing, asset price inflation, the housing market, cryptocurrency, for example, who could have predicted those? Nobody. I even did some digging back in the YouTube archive to see what John Bogle himself, the founder of Vanguard, had to say about future returns back when he was with us in 2016. Now just listen to this.
We're looking ahead to some challenges compared to what we've had in the past. Today, the dividend yield is 2%. The growth in earnings over the past 50 years has been about 6.5%. I don't think it's going to be that high, so I use 5% for earnings growth. And that gives me a 7%, roughly a 7% investment return on stocks. The problem is in the valuations. And today the stock market is selling at about 23 times earnings, and the long-term norm is 17 times earnings. That would mean you'd lose 3% of that return.
So down to 4%.
Down to 4%. And the bond returns, the Treasury is, 10-year Treasury, which is the basic benchmark, is at 1.6%. By going a little longer and a little less in governments and federal securities, U.S. government securities, you could probably get a 2.5% return without an awful lot of problems. So you've got that 4% for stocks, 2.5% for bonds. And I'll use a 50-50 portfolio because it makes the math easier. That's around 3%.
Quite interesting hearing those kind of conservative predictions for the next 5 years after 2016, when in reality the S&P 500 as a benchmark has returned over 116% as the date I'm recording this video. Sometimes this is just the reality of life, and there's so much outside of our control in the world of investing and the world of finances. There are so many things that are interconnected that we have no influence at all. The only thing we can do as investors is decide how much money we're going to put in every month, how long we're going to put in for, and what we want to invest in. Outside of that, it's a free-for-all. And finally, this research did remind me that we're all potentially playing a different game. The market is there for everyone. Some of us want to get the most maximum returns we can. Other people are more preserving capital and want to make sure that they just beat inflation. Everyone's totally different. I mean, certainly from my perspective, I'd never touch a 60-40 bond portfolio. I hold 0 bonds, hold no expectations ever that I'm going to even touch any bonds, at least in my current position, where I want to grow my assets as much as I can. But that is not the same position, especially if you've already got a huge asset pile and you really just want to protect it. Although having millions and millions of pounds sounds really good, actually, if you're given the job of saying, go and invest my money, it's a bit more daunting than you might expect. And hey, the next decade could completely reverse. The US market could stay quite stagnant. Outside of that, European markets and emerging markets could have an absolute tear. Literally, nobody knows what could happen. Again, all we're reminding ourselves is to be well diversified, have a balanced portfolio, make sure we expose ourselves to as many assets that can inflate as possible, because no one knows where the next boom's going to be. If you do know and do have a time machine, please let me know in the comment section below, but keep it quiet, put it in some sort of code or something. There's nothing wrong with hoping for the best in the future, being really, really optimistic, but making sure that your plans and your expectations are set just a little bit lower, because you'll set yourself up in a much better position. And I think future you will probably be pretty grateful. Anyway, if you've enjoyed the video, please drop me a big fat like. It really helps out small creators like me. Subscribe for many, many more videos. I'll see you in the next one. And as always, happy investing.